Welcome to all of you. This lecture is designed to discuss the practical issues in preparation of statement of cash flows or cash flow statement as per the requirements of the IAS 7 or INDAS 7. So, in the last lecture, in which we discussed the various requirements of the IAS 7 and INDAS 7 to prepare the statement of cash flows, we discussed the various kind of basic concepts. We discussed the structure of preparing the statement of cash flows as per IAS 7, and similarly, we discussed the various concepts, and we also discussed the prescribed methodology to prepare the statement of cash flows, and also we pointed out certain disclosure requirements which are to be made after preparing the statement of cash flow. So today we will continue with that, and today's focus will be to discuss the practical issues in statement of cash flows while preparing the statement of cash flows as per the requirements of these two standards. So, as far as the structure of today's lecture is concerned, firstly, we'll be discussing the basic information which is required to prepare the statement of cash flows and what are the various sources from where this kind of information will be available. Number one. Number two, we will be discussing what are the various steps to be followed for preparing the statement of cash flows. Thirdly, we will be discussing the practical format of the statement of cash flows as prescribed by the IAS 7 or INDAS 7. So finally, we'll be discussing some practical questions to understand the preparation of the statement of cash flows. One thing is very, very important from the point of view of practice, that as far as students are concerned, though they are studying the preparation of statement of cash flows right from plus one plus two to till their graduation, but at that time the focus was only the preparation, and sometimes we ignore many things which are prescribed, the disclosure requirement methodology which is prescribed under the international accounting standards or the converged format of the international accounting standard, that is IND AS. So in India also we now have a new standard which is INDES 7, which deals with the cash flow statement or statement of cash flow. So today we will be pointing out the various practical aspects in preparation of the statement of cash flows, and we will also be discussing that how to move ahead with step by step procedures, because in the previous lecture, also in the previous module which was relating to statement of cash flows, we discussed that operationally while preparing the statement of cash flows, we divide the cash related activities into three segments, that is cash from operating activities, then we prepare the cash from investing activities, and finally we prepare the cash from financing activity. So when we divide the cash and cash equivalent items into three segments, we may face the practical difficulties, because earlier, as far as the financial statements are concerned, which are prepared under the format of international accounting standards, they are basically prepared on due basis, or you can say the basis of in which the all transactions are recorded when they become due, whether the cash has been received or not. So now we have to convert into cash basis. So that's why there may be certain operational practical difficulties which we may have to face while preparing it, and whenever the question is before us to solve it, there may be certain issues, certain hidden information. So all this will be the today's agenda of discussion in this particular lecture. So first, we'll be focusing on what are the various basic information which is required for the preparation of the cash flow statement, and how this is obtained from the various resources. So as far as the sources of information is concerned, we can divide these sources into three segments. Firstly, we must have the comparative balance sheet at 2 points of time, that is in the beginning and at the end of the accounting period. So if you are preparing the financial statements as per the international accounting standards, international accounting standards, then we must have the statement of financial position at the 2 points of time, that is in the beginning and at the end of the accounting period. If similarly you are preparing on the generally accepted accounting principles basis, then we must have the balance sheet at 2 point of time, that is in the beginning and end of the period. Second thing, we need a statement of comprehensive income of the current accounting period, or if you are preparing the statements according to the GAAP, that is generally accepted accounting principles, then you must have the income statement or profit and loss account. Apart from that, we will need some additional data to extract the hidden transaction. So there may be in question which is placed before you, so you may be given certain hidden information that you have to extract from the data which is available with us, the information which is available to us. Some additional information may be given to you in the footnote of the balance sheet or the profit and loss account. So from that, and relating such figures with the balance sheet items or profit and loss account items, we have to prepare certain accounts, ledger accounts, and from that we will obtain the certain hidden information which is not available directly. So we have to extract that information. So basically, we'll be focusing on three kind of sources of data: statement of comprehensive income or income statement or profit and loss account, statement of financial position or balance sheet, and some additional data which we will either getting from the notes up to the accounts, or either we'll be getting from the various other information which is available in the accounting format. So this is the basic information which is required for the preparation of the cash flow statement, which is obtained from the three sources. After that, now when we have already sources of information, we have in hand the balance sheet, we have in hand the profit and loss account, we have in hand some additional information, and we have the ledger account. So from that information, we will follow certain methodology or step by step procedure, so that we can easily prepare the statement of cash flows while following the various kinds of guidelines which has been given in the IES 7 or IND 7. So basically, we follow the four-pronged strategy or the four key steps to prepare the statement of cash flows. The first step, which is very, very important, is to prepare the operating activities section. So there are three sections of the statement of cash flows. One is operating activities section, second is investment activities section, and third is financing activities section. So the first step will be to prepare the operating activities section by converting the net income from accrual basis to cash basis. As I have already told you that when we prepare the financial statements, basically we prepare on the accrual basis. So whatever income is stated in the profit and loss account or statement of comprehensive income, that is stated on the basis of accrual basis. So whenever a transaction happens, that is recognized. So if sale is made either cash or credit, that is recognized. So because profit is accrue on that, so that's why we record it. Similarly, the expenses which are accrue, even not paid, even then we recognize them and record it on accrual basis. But when we have to prepare the statement of cash flows on cash basis, because we need information regarding the cash actually which is paid, or the profit which is actually realized in the form of cash, or the fixed assets or the investment activities or financing activities which has actually realized the cash or paid the cash. So while preparing the operating activity section by converting the income from accrual to cash basis, this is the first step. So basically this step starts with the net income on accrual basis. So we will getting this information or net profit from profit and loss account, which is already available. If profit and loss account is available, then naturally we will get the profit figure or the loss figure from that, which is prepared on accrual basis. And now, because this is prepared on accrual basis, net profit, which is stated in the income statement, may not have been realized into cash. So therefore, we will make certain adjustment related to changes in current assets, changes in current liabilities, and other items to find out the net income on cash basis. So the resulting cash basis net income is called cash provided by the operating activities or cash from operating activities. So this will be our first step. So in the first step, we will make adjustments to the net profit or net loss, regarding the non-cash items, regarding the items relating to current assets, current liabilities, and other items to find out the net income on cash basis. Similarly, there may be certain non-operating incomes which may have been credited in the profit and loss account. Such incomes are not operating income. So if they are credited to the profit and loss account, that must be deducted from the net operating profit. Similarly, if some losses are there which are debited to the profit and loss account, but they are not operating losses, adjustment has to be made for that. So this is the first step. So under the first step, we will prepare the operating activities section by making adjustments in the net profit, which is available in the income statement, which is available on accrual basis, and we have to convert into cash basis. So this is the first step we will be following. Second step is to prepare the investment activity section by presenting cash activity for non-current assets. So there are a number of non-current assets which are used in the business. For example, you have plant, property, and equipment. Fixed assets are there. There may be certain assets which are shown on the asset side which are non-current assets. So if there is any change into that, that means there may be some purchase of fixed assets, there may be some sale of fixed assets. So this step basically focuses on effect of changes in non-current assets and having cash on cash, what kind of the effect has been there because of the non-current asset, that we'll be finding out in the investing activities. So thirdly, we will be preparing the financing activities section by presenting cash activity on non-current liabilities and owner's equity. So financing activities mean the finance which we raise in the form of equity, finance which we raise in the form of loans and advances. So this step basically focuses on effect of changes in non-current liabilities and owner's equity have on cash. So whatever effect they have on cash, that may be raising of finance may be there may be inflow. Similarly, redemption of the debenture, redemption of the preference shares, all these may have effect on the cash outflow may be there. Similarly, interest activities, dividend activities may be there which are related to the finance, so that adjustments will be made and the finance activity section will be prepared. So firstly, in the first step, we will be preparing the operating activity section. Second, we will be preparing the investment activity section. And third, we will be preparing the financing activity section. And the step 4, which is the final step. And in this step, first of all, we will aggregate the figures which are got from section 1, which is operating activities, section 2, which is investment activities, and section 3, which is financing activities. So we will reconcile the change in cash. Each section of the statement of cash flows described in step 1, step 2, and step 3 will show the total cash provided by or used by each activity. And in step 4, that the net of these changes equates to the change in cash derived from the balance sheet. So in that, we will add the opening balances, and finally we will be getting the cash balance at the end of the accounting period. So in this way, we'll be following the 4-step strategy to prepare the statement of cash flow. So again, I am revised. First step, we'll prepare the operating activities section. Second step, we will prepare the investing activities section. Third step, we will be preparing the financing activities section. And in fourth and final section, we will reconcile the change in cash to arrive at the final figure at the end of the accounting period regarding the cash and cash equivalent. So in this way, the 4 steps will give us the various kinds of information, and the users of the accounting information, they may use this information for investment or some kind of decision making with regard to the firm. If they have to invest in the business, they have to give a loan to the business, supply goods to the business, or invest in the debentures of the organization or any other thing. They can take decisions on the because financial institution may be interested in getting various kinds of information for various kinds of decisions, so which are related with the cash or operating, financing, and investing activities, or their operations during the period, they can see to it. So in this way, the 4-step strategy we will be following to prepare the statement of cash flows. Now let's come to its operational part, how it is actually operated, because we have defined that we have 4 steps. First step is dealing with the operating activities. So first we'll be focusing on the operating activities. That means how the cash from operation activities or the operating activities is arrived at. So as far as arriving at the figure of cash from operation is concerned, there are two methods for that. First method is direct method, and second method is indirect method. So in the direct method, we will find out from the various sources, the various receipts of cash which are relating to the operating activities, and various payments of cash which are related to the operating activities, and finally we will arrive at the figure of cash from operations. So while finding out the receipts from various sources, for example, sale is there, cash sale here will be taking, cash expenses we will be deducting. So in this way, that in direct method, we will find out the figure of state cash from operations by finding out the direct receipts in the form of cash and payments in the form of cash, and we will be arriving at the figure of cash from operation. But usually the most important method which is followed for preparing the this section of operating activities section is indirect method. Indirect method means we have already the figure of net profit, which is either available in the income statement or statement of comprehensive income in the form of net profit or loss. That is based on the accrual basis, that is prepared on the accrual basis. Now while getting this net profit, we have debited so many items which are non-cash, we have credited so many items which are non-cash, or debited so many items which are non-operating in nature. Similarly, credited so many incomes which are non-operating in income. Similarly, we have to make adjustment regarding the working capital changes, that is increase in the current asset, decrease in the current asset, increase in the current liabilities, decrease in the current liability. So after that, after making adjustment, we will be arriving at the figure of cash from operation. So I will be detailing this in this the chart which is available on your screen. You can see how the cash flow from operating activities is got. So first of all, the first point is we have to get the net profit and loss account difference between closing balance and of the profit and loss account and opening balance of the profit and loss account. So there are two methods. One is you have available income statement, you can find out the net profit as shown in the income statement. Or if that income statement is not available, you may be having balances of in the balance sheet, profit and loss account balance in the balance sheet. So we will find out the difference between closing balance and opening balance, and final figure may be uh, profit, net profit as per profit and loss account, or net loss as per profit and loss account. Because this figure which we have arrived at, in this so many appropriations may have been made. For example, some amount has been transferred to reserve, some proposed dividend for the current year may be there, some interim dividend may have been paid during the year, some provision for tax may have been made during the year, some provision for extraordinary item which may have been debited to the profit and loss account. So we will add back them, because this basically that is not relating to the operating part. So if you have transferred to reserve from profit, that will be added back. If you have proposed dividend for the current year, that is debited to profit and loss account, that is added back. Similarly, you may have interim dividend paid during the year, because interim dividend is basically appropriation of profit, not a part of the operations of the revenue generating activities of the business. Similarly, extraordinary item, if any, debited to the profit and loss account, which is not related to the operating part, that will also be added. So these are the four additions, 4 or 5 additions. Similarly, we will deduct something, any extraordinary item which has been credited to the profit and loss account, but which is not operating income. So that we will be deducting from the net profit. So refund of tax credit, if it is credited to profit and loss account, because this is not an operating income, so we will deduct it. So we will be having net profit before taxation and extraordinary items, that will be all deducting. So this figure will give you net profit before taxation and extraordinary items. So similarly, in the B part, we will add non-operating expenses. Non-operating expenses mean expenses which are not operating expenses but has been debited to the profit and loss account. For example, depreciation is a non-cash item. Though depreciation is debited to profit and loss account as an expense because it is a charge to the fixed assets, which has deteriorated over a period of time because of flex of time, because of use of this asset in the business, but it do not involve outflow of the cash. So that's why it is added back. Similarly, preliminary expenses which are shown on the asset side, discount on issue of share which is shown on the asset side of the balance sheets over a period of time, if these are written off and this charge has been made to the debit side of the profit and loss account. So if any it is there. Similarly, debentures are written off, discount on debenture on issue of debentures is written off, that will be also added back. Similarly, goodwill, patents, trademarks which may be amortized over a period of time, so this will also be, if it is debited to the profit and loss account, that will also be added back. Similarly, interest on borrowing capital and debentures, that will also be debited to the again added to the profit and loss. On loss on sale of fixed assets, this is not an operating expense, operating loss, so therefore it will be added back. Now, third is C section, which is non-operating income, which are credited to the profit and loss account. So all non-operating incomes which are credited to the profit and loss account will be deducted because these are not operating income. So interest income may be there, dividend income may be there, so rental income may be there, so profit on sale of fixed assets may be there. So in this way, we'll all deduct these incomes from the net profit, which is shown in the income statement. D part, we will adjust certain operating profit with working capital changes. So whatever the working capital changes has been there. So working capital changes may be two kinds. Number one, it may relates to decrease in current assets and increase in current liabilities. If there is a decrease in current assets, it means cash has been realized, so it will be added back. Similarly, if there is a increase in current liabilities, so it means cash has not been paid outside. So to convert it on cash base, we will add back to that. Similarly, for example, decrease in stock and inventories is there. If there is decrease, cash is realized. So if there is a decrease in debtors, bill receivable, it means cash has been realized from the debtors. Similarly, decrease in accrued income. So accrued income basically now which is decreased, it means it is charged to the profit, now it means realized. So decrease in prepaid expenses. Similarly, regarding liability side, increase in creditors and bills payable, increase in outstanding expenses. Similarly, increase in advance incomes, it means more income has been received in the form of cash. Similarly, increase in provision for doubtful debts, they all will be added back. So now, similarly, there is an increase in current assets. If there is an increase in current assets and a decrease in current liabilities, it means cash has been paid out. So decrease in stock, decrease in debtors, bills receivable, decrease in prepaid expenses, increase in creditors, bills payable, increase in outstanding expenses, or increase in advance income, they all will be deducted from that. So finally, if any provision is made for increase in provision for doubtful debt, that will also be deducted. And finally, we'll have the cash generated from operation, that is D plus E minus F. So if income tax has been paid during the year, net of tax refund received, so that will also be deducted. And plus minus for extraordinary items which may relate to the non-operating or operating part, that will be adjusted here. And finally, we'll be getting the net cash from operating activities or net cash used in the operating activities. In this way, this is the structure how we calculate the first part, that is the cash from operating activities is arrived at. Second, while discussing this, whatever we have discussed over the here regarding this, you may have witnessed certain kind of adjustment regarding to the working capital. So let's discuss one by one, then we move to the practical aspects. So account receivable change. Account receivable means your debtors, your bills receivable, etc. So an increase in account receivable hurts cash flow. If there is increase in the debtors, increase in the bills receivable, it means sale has been made, but the cash is not received. So similarly, decrease in account receivable change will help us to realize cash flows. Debtors have been decreased, it means we have got the cash. So similarly, bill receivable has been decreased. It means that amount is realized in the format of cash. So the account receivable assets show how much money customer who bought products on credit still owe to the business. And this asset is a promise of cash that business will receive. So cash doesn't increase until the business collects money from the customers. If bill receivables or debtors are increasing, it means the business has not still collected the money from the customer. So that's why the adjustments are needed in the cash from operating activity. Similarly, the inventory change, an increase in inventory or stock hurts cash flow. It means if the closing stock is increased over the area, so it will hurt the cash flows. It means inventory has been purchased. So similarly, a decrease help cash flows. It means amount has been realized. So inventory is usually the largest short-term asset of the business that sell products. Similarly, prepaid expense change is there. An increase in prepaid expense, yeah, that is an asset account, hurts cash flows. And if it is decreased, that helps cash flows. So in this way, we make adjustments. Similarly, changes in the operating liability, that is the current liability. So increase in short-term operating liability helps cash flow. uh, if it is increased, it means cash has not been paid to them, it will be help the cash flow. So if it decrease, it means payment has been made to them, so it hurts cash flow. So that you think should be taken into account. The most important factor which we have discussed above is a depreciation factor. So recording depreciation expense decreases the book value of the long-term operating fixed assets, but there is no cash outlay when recording depreciation expense. So each year the business convert part of the total cost invested in fixed assets into cash. So it recover this amount through cash collection from sale. Thus depreciation is a positive cash flow factor which we must consider regarding this. So, in sum total, we can say that increase in assets must be funded and so represent the cash outflows. So, similarly, increase in account receivable imply that fewer people paid in the cash. Increase in inventory imply that they were purchased. A decrease in assets is a source of funding and so represent a cash flow. So, decrease in account receivable imply that cash has been collected. Decrease in inventory imply that they are sold. So accordingly, changes in other current assets can have a positive cash flow impact if they decrease from one period to other, or a negative cash flow impact if they increase from one period to the next period. So this is the thing, overall scenario which we must consider while preparing the cash from operating business. Now let's move to the second part, which is cash flow from investing activities. So here we will be following the direct method. So we will be getting the proceed from the sale of fixed assets, proceed from the sale of investment, proceed from the sale of intangible assets. Similarly, you may have received certain interest and dividends, but this is for non-financial companies also. If it is a financial company, so their receipts will become in the financing activities section. So similarly, you may have received certain rent income, that is outflow, income, that is income. Similarly, you may have purchased certain fixed assets, you may have purchased certain investments, you may have purchased certain intangible assets like goodwill, etc. These all three will be treated as outflow. The amounts brackets are shown in the negative, that means that's an outflow. So in this way, net cash from financing activities or used in the financing activities is find out. Similarly, third part will be preparing regarding the cash from the financing activities. So here also we'll be following the direct method, proceed from the issue of debentures and shares, proceed from other long-term borrowings, final dividend, interest and debentures and loan paid, repayment of loans, redemption of debentures and preference shares. So the amount which are shown in the bracket 5, for example, final dividend paid, this is outflow, interest and debentures and loan paid, this is an outflow, repayment of loan, this is an outflow, redemption of debentures, preference share, this is an outflow. So inflows are proceed from the issue of the shares and debentures, proceed from other long-term borrowings, and these are the two basically, or it may be other activity which is financing and some proceeds may be there. So finally, in fourth section, we will aggregate them. That is, figure from step 1, figure from step 2, and figure from step 3 will be aggregated, and we will find net increase or decrease in cash and cash equivalent. And fifthly, we will add back all opening balances of cash and cash equivalents in this figure, that may be in the form of cash in hand, that may be in the cash at bank, less bank overdrafts, short-term deposits, or it may be marketable securities. And finally, we will arrive at the cash and cash equivalents at the end of the year. So it will reconcile the figures, and we will be getting the final figure of cash and cash equivalent at the end of the year. So this is the process of preparing the statement of cash flows or cash flow statement as per the IND AS7 or AS IAS7. So we will be following certain disclosure requirements. Disclosure requirement, whatever the figures has been given, how it is calculated, that will be coming into the notes to the accounts. So this is the process which we follow for preparing the statement of cash flows or cash flow statement. Now let's come to the some examples or practical issues when we prepare the statement of cash flow. So we will consider one by them. So this is one example. On the left side of your screen, you have one question, which is a very short question. And I think when we proceed to prepare the statement of cash flows, we will start from the some simple problems so that we can understand the practical aspects in a very easy manner. So in the left side, you have been given this kind of the figures regarding opening balance of cash, closing balance of cash, decrease in assets and liabilities, that is current assets and liabilities, decrease in debtors, increase in creditors, similarly sale of fixed asset, redemption of the debentures, and finally you have been given the figure of net profit for the year, which is 20,000. So our steps by step strategy is there. So first step is to find out the cash from operating activities. So here you cannot use direct method because the receipts of cash and the payments of cash which are related to the operating activities has not been given here. So we will be following the indirect method, which is the arrived figure given it to us is net profit for the year. So we'll be starting from net profit of the year, which is 20,000, which is given to us. So now in this net profit, we will make certain adjustments regarding non-cash item, but they are not given here. Here we are given only two figures, which is in the format of decrease in debtors or increase in debtors. So if there is an increase in debtors means the debtors has been increased, but the cash is not realized. So therefore, the net profit is showing a figure which is here the decrease in debtors is given. So decrease in debtors means 5,000, which means cash has been realized. So whatever the decrease in debtor is there, 5,000 will be added to that. Similarly, there is increase in creditors. It means payment has not been made. So increase in creditors will also be added. So there are two items which are given regarding the current assets and current liabilities. Current assets are showing decrease. That means cash is realized. It will be added back. Increase in creditor, that means increase in current liability. It means when increase in current liabilities there, we have not made payment, so cash remains with the business. It was also added. So 7,000 plus 5,000, total 12,000 is added, and the net cash provided by the operating activity comes to here 32,000 rupees. So now next step, second step, which is cash flow from investing activities. So cash flows from investing activities, which is related with the sale of fixed assets. Here 20,000 proceed from the sale of fixed assets is here. That 20,000 will be resulting in the investing activities, cash from investing activities. So 20,000 will be added. So lastly, we come to the cash from financing activities. Here, the figures relating to redemption of debenture is given. That means outflow is made during the year. So redemption of debenture 50,000 in bracket means negative amount. So 50,000 will be the cash outflow from the financing activities. So fourth next step will be find out the net increase and decrease. That means A plus B plus C is aggregated. So 32,000 plus 20,000, 52,000 minus 50,000, that is net decrease in cash. In that net increase in cash, that is A plus B minus C is 2,000 rupees. So here we'll add the cash balance at the opening, which is 10,000. So we'll be finally arriving at the cash balance at the closing balance, that is 12,000. So in this way, it's a very simple example. So the impact of current liabilities and current assets is shown. how the net profit is arrived at by adjusting their figures. This is a very simple example in which we have been shown the how to prepare the cash flow statements. So, but it needs practice, because unless you make practice, you will not be getting some kind of results. So now let's come to again another uh, figures. Next point is, next question we have taken is a detailed question. Left side of the screen, you see that there is one balance sheet which is given to you on 31st March 2006, and one balance sheet on 31st March 2007 is given, along with some additional information. So you have the balance sheet. Income statement is not given. So if the income statement is not given, we will start from the profit and loss account balances, which are given in the liability side of the balance sheet. So again, we will be moving step by step. So first step will be finding out cash from operating activities. On the right side, we'll have made certain calculations. So first figure we require is net profit as per profit and loss account. How it will be arrived at? Let's move to the left side. Left side, opening balance of profit and loss account is 1,10,000 and closing balance is 2,70,000. So it means during this period 1,60,000, the difference of the opening balance and the closing balance is 1,60,000 is a profit which is earned during the year. So as discussed in the beginning, now we will make certain adjustment for appropriation of fund. What has been appropriated out of this profit? So let's come to first the additional information which are given here. So here it is written that we have 12% preference share capital. In the beginning it was 2 lakh, and at the end it was 1 lakh. So preference share, these are redeemed at the end of the period at the premium of 5%. So it means preference share capital remains throughout the year rupees 2 lakh, but at the end day we redeemed them. So 12% preference share means preference dividend has to be paid at the rate of 12%. So 2 lakh was the opening balance. On this 12% amount of preference dividend will be paid. That becomes 24,000. So if it is deducted from the profit, we are add back now. So preference dividend 24,000 will be added. Then in preference dividend, it is written that interim dividend of at the rate of 15% was paid on equity shares on 31st March 2007. And equity share capital opening balance was 3 lakh. But it said that in the note that the equity share was also issued on 31st March. So it means throughout the year, 3 lakh was the balance of equity share capital. So on which 15% interim dividend was paid. So it comes out to be 45,000 rupees. So interim dividend 45,000 will add back here. And finally, you see on the provision for doubtful debts. Provision for doubtful debt has been made. So earlier it was 10,000, now it is 15,000. So it means 5,000 provision from profit has been made. So this will also be added back because this is also non-operating and a non-cash item. So net profit for the before tax comes out to be 2,34,000. So now non-operating expenses, the expenses which are debited to profit and loss account, either non-operating or non-cash, that will be adding back. So in the additional information, depreciation charge during the year 70,000 has been written. So 70,000 we will show here, add here as a non-cash item. Similarly, now let's come to the loan side. First of all, you have 10% debentures, 1 lakh to 2 lakh. So the amount has been raised at the end of the year, but on 1 lakh, 10% interest you have paid, which is charged to profit and loss account. So that comes out to be 1 lakh. So interest on long-term borrowing, that is the venture, 10,000 will be added back here. Similarly, first note is given that a machinery with a book value of 40,000 was sold for 25,000. So 15,000 loss on sale of investment is there. That is also here added back. So similarly, preference shares are redeemed at a premium of 5%. So 1 lakh shares are redeemed, 5% premium will come out to be 5,000. That is also charged to profit and loss account. So 5,000 we will show it, and this amount will be also be added. So this comes out to be 3,34,000. Now adjustment for the current assets and current liability. Now let's come to the first of all. Here some non-operating incomes are also credited to the profit and loss account. For example, you have 10% investments. So 10% investment in the beginning was 30,000. So on this 10% investment, interest will accrue. So this 3,000 has been credited to the profit and loss account. So therefore it will be deducted now. So interest on investment 3,000 will be deducted, and this will give you operating profit before working capital changes, that is 3,31,000. So now we'll make adjustments for the current assets. So current assets, first we have, let's see, debtors. So as far as the debtors are concerned, so in debtors we have this amount of 1 lakh, and there is an increase of the debtors. So it means there is an increase of the debtors. So it means when debtors are increased, cash has not been realized because there may be some credit sale. So this amount will be deducted out of this. So 1 lakh here will be deducted. So similarly, stock is decreased. So if there is a decrease in stock, it means cash has been realized. 10,000 has been decreased, 1 lakh to 90,000 it comes. So here decrease in stock of 10,000 will be added. So increase in similarly here creditors, let's 70,000 is there, now it becomes 1,40,000. It means payment has not been made, so this is the source. So 75,000 here will be added. So it comes out to 4,60,000, out of which uh, increase in current assets is deducted 1 lakh. So net cash from operating activities 3,16,000 we will come at. So this is the process we follow. Now to find out the other activity, let's move to the, for example, we have to prepare the investing activity. Let's come to that. Here let's come to the fixed assets net account. Some additional information is also given, and for this purpose we will prepare the fixed asset account. So we have opening balance of fixed asset 5,10,000 and closing balance 6,20,000. So this will come into the fixed assets account. So two brought down balance is 5,10,000 and closing balance is 6,20,000. So in figures also, a machine with a book value of 40,000 was sold for 25,000. Here loss is also there. So this will be recorded in the fixed assets account. By bank 25,000, by profit and loss account 15,000, and similarly we have been given depreciation, so which is charged for 70,000. So that will also come here on the credit side of the fixed account. And finally we'll be getting the purchase figure of the fixed asset, which is 2,20,000. So here it means the first activity, cash from investing activities, will be purchase of fixed asset, that is negative 2,20,000. Similarly, now a machine has been sold for 25,000. This is a cash realized, so 25,000 plus. Similarly, you have investment 30,000, on that 10% interest has been received. So interest on investment 3,000. So similarly, investment has been purchased during the year, because earlier the balance was 30,000. Now it is 80,000. So it means purchase of investment 50,000 is given. So net cash used in investing activities comes out to be 2,40,000. So in this way, the second part we find out the cash from investing activity. Now let's move to the third part, that is cash flow from financing activities. Here also I have just highlighted the question on the front, and then C part. Let's see, equity share capital, which was earlier 3 lakh, now 3,50,000. It means 50,000 has been realized from the issue of share capital. Similarly, let's see the debentures, which was earlier 1 lakh, now it has become to be 2 lakh. So out of this you can see that discount on debenture is also given. So it means 1 lakh which has been realized. So discount on debenture has comes out to be 10,000 to 15,000. It means 5,000 is a discount on debentures. So it means the amount realized is 95,000. 1 lakh minus 5,000 discount on issue of the debentures 95,000. So let's come to the now preference share capital, which is already 2 lakh. Now it has become 1 lakh. It means redemption is there. So preference shares are redeemed at a premium of 5%. Here it is written. So it means a redemption of preference shares 1 lakh plus 5,000 premium, 1,05,000 is an outflow. Similarly, interest paid on long-term borrowing. The long-term borrowing are our debentures. That means 1 lakh is the opening balance. The interest paid on long term will be 10% of 1 lakh, that is 1 lakh 10,000 rupees. So similarly, interim dividend has been paid, that comes out to be 45,000, that is 15% of the 3 lakh 45,000 outflow is there. Similarly, preference dividend is given 12% of 2 lakh, that is 24,000. This is an outflow. So net cash used in financing activities come out to be 39,000. So similarly, now we'll be finding out the net cash increase in cash and cash equivalent, that is 35,000, and cash, and it will be added cash and cash equivalent at the beginning of the year 40,000. So final balance of cash which is shown in the balance sheet, that is here cash in hand and cash at bank 35,000 plus 45,000, that is 75,000. So in this way the cash flow statement is prepared. So this we will process we will be following for preparing the statement of cash flow. So in this question we have taken the elaborative way to find out the cash from operating activities. The first slide which is shown here is the question. This is the basic format of finding out the statement of cash flow from operating activities. Similarly, second part, here the question is also shown, and then cash from financing activities. And C part, we prepare the cash from financing activities along with some working note, because wherever you have to find out some missing figure, you can prepare the ledger account and find out the missing figure from that, as we have prepared in this question, fixed asset account at written down value method. So the cash flow statement, and finally, if I say the cash flow statement shows cash flow from three different areas, that is operating activities, investing activities, and financing activities. And operating activities, the cash flow from operating activities encompass the revenue generating activities of the concern for a practice. For example, cash received from the product of sales, payroll, and supplier invoices. Similarly, investing activities, the cash from these activities include all payments made to acquire any long-term asset as well as cash received from the sale of long-term asset. For example, if you have purchased a building for your practices in, that cash outflow would be categorized as investing activity. Similarly, financing activities, these are those that will alter the equity or borrowing for practice. So for example, dividend payment or sale of or purchase of practice shares. So now we have broken down the different categories of the statement of cash flows. I would like to point out why it is important to read this statement when making long-term plans for your practice. Number one, if the cash from operating activities is greater than the net income, which means that the net income of the practice is considered to be high quality. Secondly, however, if the cash from operating activities is less than the net income, then the question arises as to why the income is not turning into cash. So this is a red flag for your practice and indicates that changes need to be made. So the cash flow statement give you so much information. The stakeholders are free to use these kind of information for taking the various kind of decisions. So one thing is very clear, though I have explained to you how this is prepared online, the step-by-step procedure with the help of one or two questions, but it is my dear student, it is your practice which will make you perfect. So I hope you may have got some benefits. I don't say that whatever I have told that is final. There may be certain additional information, there may be certain inputs which you would like to give to me. So you are all welcome, because whatever we are doing, that is doing for the benefit of the students. So thank you very much. So in this way, we'll continue in the next lecture also. Thank you so much.